Hello, and Happy New Year to you all. I'm Barnabas Aks, Global Business Development Director for Sustainable Finance and Refinitiv. Before we begin, I'd like to cover a few housekeeping items with you. First, some technical notes. Click the media player on your screen to enable sound and video and ensure that Flash is enabled on your browser. If the slides are stuck, please refresh your browser at the bottom of your audience console screen. You can expand your slide window by clicking on the maximize icon on the top right of the window or by dragging the bottom right corner of the slide area to expand it. You can also expand the live stream window box. Please submit your questions to the speakers in the Q&A box. We will answer these at the end of the webinar. And finally, the link to the recorded webcast will be emailed to you after the conclusion of the event. So before we start this very interesting webinar about the new angle of ESG performance of companies and countries, I thought that we would ask you a question about what do you think focusing on ESG usually leads to having higher stock returns. So if you don't mind just pushing and selecting the relevant answer, that would provide some lovely insights before we begin. So let's see where we are with this. Ooh, yes, sustainability enhances a firm's financial performance. 79% chose that answer. A great start by all means. So this slide then about ESG in 2020 might not be unfamiliar to you. What I would want to highlight that both despite and as a result of COVID-19, sustainability and ESG broke new records in 2020. On the investment side, on the left-hand side, 2020 saw a record $464 billion USD flow into ESG funds, more than double of the 2019, which was also a record year. The share of passive investments reached 40% in that ratio. On the financing side, on the right-hand side, the issuance of sustainable finance bonds totaled $544 billion during the full year of 2020, more than double of the issuance level of 2019, and an all-time annual record as well. So the momentum will continue owing to the national commitments to tackle climate change and ensure just recovery, and asset managers making ESG integral part of their workflow. So you see a couple of examples of national commitments, and of course BlackRock's commitment of announcing its $7 trillion in assets will be governed by the ESG considerations. Deloitte forecasts that ESG mandated assets could make up to half of all managed assets in the US alone by 2025. We thought, in hindsight of this, it would be interesting to gauge your view about another question, which would be this. So we understand that 79% of you are considering ESG as a good addition to Alpha. So what do you think about using them? And advancing to that. Wow, even better. Look at this, Richard. 81% using yes. So we would want to provide some additional insights to this. When talking about ESG data, we have to consider two very distinctive data sets, corporate reporting-based data, which you see on the left-hand side, and news and social media-based data and ratings, which you see on the right-hand side. The former provides access to structured view of a company, reported publicly available heavily textual data, interpreted and transformed into ESG rating involving heavily analysts' expertise. Now the latter, the ESG sentiment, enables understanding the public's perception of a company's performance through numerous news and social media sources powered by AI. The corporate reporting ratings and media sentiments have key differences in the source of information, the process of data collection, in the frequency of updates, and the type of historical series, i.e. a point in time or not. Although generally different, in the case of Refinitiv and MarketPsych, company-related and media sentiment-related rating methodology is aligned. Data collection is analyst-driven, although supported by AI. The updated frequency is way lower in the corporate reporting-based rating. Point in time is only available so far in the sentiment-based rating, although the other side will also provide that feature in the second part of 2021. The ESG media sentiment discussed in this webinar is built on Refinitiv's methodology and on MarketPsych's multi-decade expertise in the field of natural language processing to ensure the value provision. As a result, co-using the two very distinctive data sets became possible and possibly provides immense value. Social media has the potential of being a leading indicator for corporate reporting-based rating changes. With that, I pass it on to Richard Peterson, the CEO of MarketPsych, to share the insights about the new angle of ESG performance. Just to introduce him a little bit, Dr. Peterson is a psychiatrist and an award-winning financial writer and associate editor of the Journal of Behavioral Finance. He has published widely in academia and performed postdoctoral neuroeconomic research at the Stanford University. Richard, very welcome, and over to you.
Thank you, Barney, and welcome everyone. I wish you a good morning or good evening, depending on where you are. When we look at ESG data, we're looking at it from the perspective of the media. What does the media say, whether news or social media, about the ESG actions at a given country or a given company? So here's a slide that shows plastic on a beach in Bali. And the social media account that published this got a lot of attention, of course. And plastic is a big problem in the ocean and, of course, on beaches. I actually lived in Bali for a year, a couple of years ago. My kids went to the green school there. And in fact, while we were there, I remember swimming several times and pulling up plastic bags on my hands, or having a raft of plastic float over us while we were snorkeling or diving. It's a real issue, and there's real environmental consequences. So this is clearly an ESG controversy. Yet on the other hand, here's a depiction of Elon Musk drinking whiskey and smoking marijuana on the Joe Rogan podcast. And you can see in the chart here, on the red line, we have the share price of Tesla, the red dotted line. On the blue line, we have references to management sentiment. So we have the overall feeling towards management. You can see, based on the scale here on the side, it was slightly positive. People were quite positive about Elon Musk. Then he smokes marijuana on the podcast, the news breaks, and his sentiment about management at Tesla becomes quite negative. Although it actually bottoms out and starts to rise again, and the share price did as well. Now the share price is over 12 times what it was just 2 years ago. So we see that there are short-term impacts, certainly. But I think for all of us who are longer-term investors, we wonder, is there a long-term impact from ESG controversies? So in the case of Bali and plastic on the beach, we wonder, well, why is this not cleaned up? What are the institutional or psychological or cultural issues that prevent this issue from being addressed properly? And then when we see something like Elon Musk and we say, well, this is a high-powered CEO, now the wealthiest individual in the world, and what would cause him to make a management misjudgment like this on public media? And there are a number of factors, whether psychological, educational, cultural, that affect how we interact with the sustainability concepts and whether we even care about sustainability and take actions to address it. And so our data set is actually designed to look at these in detail and to attempt to find what is it that's impactful for long-term value of a company, as well as short-term value of a company, as you saw from the Tesla example. So here's what we see longer term when looking at something like management sentiment. And after I explain this research, I'll go into more detail on how we create this data set. But I just wanted to give you an orientation to what this data is before we jump into the explanations. So this is a study performed where we looked at the past 1 month of management sentiment for US companies in the S&P 500. And we ranked those companies by their average media sentiment or management sentiment during that past month. And this is management sentiment derived from both news and social media. And so what we did here then was we ranked them by that management sentiment during the last month in the media, and then we tracked their price going forward for the next month. And we created a portfolio. So the top 10%, the top 50 companies in the S&P 500 with the highest management sentiment. In the last month, we tracked their share prices forward for the next month, and then the bottom 10% as well. And you can see there's a nice spread here. It's about 2.2% annually that these companies drift apart, that well-managed companies, according to the media, seem to outperform those that are poorly managed. And so then the question here is, does this translate into actionable value? And based on this type of research, we think it does, that there is value in understanding not only the insider view of the management, but also this external view. What does the media say? What does social media say about this management team? So I'll describe now how we go about determining sentiments in media about various sustainability topics. We go into a lot of detail. We have over 4,000 nuances that we track. So while I will talk about sentiment, we are also tracking much more detail, actions around sustainability, emissions controversies, flare-offs of methane. We have all sorts of details that we're tracking. And there's, like I said, there's over 4,000 of those. And our own background in producing this product is in behavioral economics. And then my own background, of course, as a physician is in public health. So we're curious, how is it that we can create a more healthy world? And how can we do that by understanding and quantifying what's already happening in the world? So we got our start with research on how people take risk in financial markets. And so you can see our first book was Inside the Investor's Brain. Most recently, we wrote Trading on Sentiment based on our data set called the MarketPsych indices that we produce with Refinitiv. That was a very complex data set, and so we since produced a predictive model based on that, which launched January of last year. And that has performed very well during last year, showing that not only do we believe and show you evidence that there is value in this data, but we do have a positive track record now of a public product that purports to predict stock prices and actually is doing so, based on this type of analytics. And then now we're launching the Refinitiv MarketPsych ESG Analytics based on similar technology, but of course much more advanced now and focused on ESG factors specifically. Now we do have 55 academic papers written on this data set, and we have customers now in over 25 countries. So this is not just a new data set being launched. We've been doing this work for 16 plus years. So we've been looking at how to quantify these issues in the media for a long, long time. So we first crawl data, like you can see this headline, shares of China's Luckin Coffee plummet 80% after investigation finds COO fabricated sales. So we are, of course, first obtaining the data via news feeds and social media feeds that we license. Then we analyze that using natural language processing. And we're able to pull out significant aspects of the phrase or the article, like this is about an event in China or related to China. This is Luckin Coffee, which is a specific entity. There's bearishness being reported, and more impactful, controversial, there's a management investigation of this company. And then we aggregate those findings that we digitize into scores that we can release in indexes. So we can have an index that's been rolling forward on management sentiment. Just like we saw with Tesla, we can create a time series of all the commentary about management sentiment for Luckin Coffee. And as an article like this comes out, it creates a negative impact on Luckin Coffee. Then we can also measure not only these positive or negative balance type indexes where we're looking at over time, is the management sentiment rising or falling, but we can also see accounting controversies, for example. And so whenever there's a specific accounting controversy, we can create an alert, and that pops up in our accounting controversy index. Now, both of these, I showed you management sentiment, and I'll also show you results from accounting controversy. Again, these are not results of what already happened. These are results where we find what the media is saying, and then we predict what happens in the future. And that's the quantitative research that we'll show you shortly. Now, this data set is built to mesh with the existing Refinitiv fundamental ESG data set. So Refinitiv already has a group of 150 human analysts around the world tracking corporate filings. They also have some AI-based techniques where they look at news controversies, and they update that every week to 2 weeks. In our case, we wanted to have something in essentially real time and point in time back to 1998, where you can look through all of the media and use this to create really robust and reliable quantitative studies where the weightings and the techniques are static over time, so there's no changes in how things are constructed. And we use the same structure. So like I said, we have 4,000 underlying meanings that we pull out of text. And then with those 4,000, we aggregate them into about 250 scores and indexes. Management sentiment is one of those. Accounting controversy is another. We also have some around emissions and airborne releases. And so we have these details. I won't go into all of them because it's 252. It's a lot to talk about. But I will show you results from several that were quite interesting. And we have two packages in the way we deliver this data. We have an underlying data set that's called the advanced package, which is really detailed. So that's the one where we have 60-second updates. So you can have an alerting system. Every time there's an ESG event that might be a controversy, that comes out very quickly. We also have an hourly feed and a daily feed there. And that's where we have the 250 plus indexes for companies and countries. We have, though, also a more consolidated index, which is 16 scores that are meshed with the Refinitiv indexes based on, of course, an ESG score, then an ESG controversy score, and also the pillar scores, which are the environmental, social, and governance score, and then 10 category scores, which underlie those pillars. And if you'd like more detail, we can provide you documentation later on. So here's an example, again, of what this data looks like visually. So in this case, we're looking at Citigroup, and this is their management diversity index. What we're pulling out of the media, all the references to management diversity since 2013. And you can see there weren't a lot of references to management diversity back in 2013, but starting in the middle of 2017 or so, that became a big focus at the company. And you can see the media references as well starting to rise and rise. Now, earlier this year, Jane Fraser was named as the CEO, the first female CEO of a major American bank. And so you see the big spike in management diversity references there in our management diversity index. And so we can not only track events like this, but we can see that Citi was already focused on diversity, and their board had become much more diverse over the prior years. And then we also just superimposed a short study done in 2020 on the FTSE 350, which showed that when there are more women in the management team, there does seem to be higher profit margins at companies. So what does the market think about the increased diversity at Citi? And so we have another index that can track that. We have a management trust index, which is not focused on diversity. It's simply all the references to whether the media believes the management team is reliable, honest, high quality, solid. So when we pull those references together and then we subtract out references to weaknesses in the management team or vulnerabilities or criminal behavior, then we get a management trust index. And we can see Citigroup up in the top right corner of this heat map. This is for the past 30 days, and this is when Jane Fraser was announced. And you can see that Citigroup has quite positive management trust over the last month. So the media perceptions of what happened are quite positive, right? So they are quite supportive of this move at Citigroup. And this is from our Icon app, which is in the App Studio in Refinitiv's Icon. We also have this on our own website. And if you do trial our data or become a customer of this data, you'll have access to it either in our website or in the Icon app, whichever you choose. And you'll be able to use these visualization tools like our charting tools or these heat maps and screening tools that we provide as well. So we'll talk now about some of the quantitative findings we have for companies. Workplace sentiment, how companies treat their employees and how the companies talk about working at the company. These are thought to be important factors in corporate success. But what we're also seeing is maybe perhaps not only in corporate success, and we have a lot of leadership trainings and people who talk about the value of a happy workforce. We hear this a lot. I mean, Zappos, former founder, was, of course, talking about this significantly. And what we see here is the performance of the top 5% of companies that have the most extreme positive comments about their workplace sentiment, and then the bottom 5% with the most negative comments about their workplace sentiment in the media. And you can see, again, on a monthly rotation model, similar to what I did before, and all of the studies will be monthly rotations so that I don't have to re-explain it each time. We see that every month, if you rank them by their workplace sentiment and then track the stock price over the next month, you see pretty good returns. Now, we didn't include transaction costs here because this is the S&P 500, so it's quite a liquid universe. And also, it's monthly rotation, so you're not doing a huge amount of turnover with this. We also find that many of these factors have longer drift than 1 month, but 1 month seems to be a fairly good middle point between those who want to trade data short term and those who trade it longer term. But we do see longer term drift in this data as well. And you can see here, again, the top 5% versus the bottom 5%, a nice opening up here. And you can see then that we also put here those companies that are the most frequent in the top tier and the bottom tier. So in the top tier, you have groups like Accenture and Marriott. And then in the bottom, you have some like Aon and McDonald's and Flowserve and Tyson Foods, where they had some workplace injuries. So you can see the variety of companies that are actually appearing, and it is across industries. It's not just, say, technology in the top one, which has been a complaint about ESG data in the past. We do see a good diversity of findings here. Now, as I said, technology has been a bit of an issue with this data set. There was research by Bank of America Merrill Lynch where they studied 3 different ESG data sets. They studied Refinitiv, Sustainalytics, and MSCI. And they found that most of the value in the original report seemed to be coming in the past 5 years. And this report came out, I believe, in late 2018. So since approximately 2013, 2014, that's when they started to see ESG outperform. And we see something similar if we're only, say, looking at high innovation companies. So we do have an innovation index, and this is largely populated by technology companies. And so we do see here that there's significant outperformance by the top decile, the most innovative companies. But that this has really taken off since 2014, approximately. So maybe what people are finding is, yes, this is a good thing to have innovation and the increased productivity that comes with innovation. But as a quant, sometimes we wonder how stable that result is going to be if it's a recent phenomenon and it's not consistent in the history. Now, the data set that we provide here is actually back to 1998. So we do have very good US coverage to 98. However, we had a big surge of sources starting in 2005, and that's why we cut this off just at the beginning of 2006. It was because of the large increase in sources. But you can actually test this, and we do have quite interesting studies all the way back to 1998. And here's an example of another use case we find with this data. So far I've talked about portfolio construction broadly with the management sentiment and the workplace sentiment indexes. Then we talked about finding winners with this innovation index, how you can find those companies that are likely to outperform in a given environment, especially these days with the focus on innovation. And thirdly, you can manage risk with this data. So we have this index called accounting controversies, and this is references to accounting misstatements, accounting questions, accounting problems at companies. And when we quantify accounting controversies, as we lump them together and call them, we see that those that are in the top 5 or top 10% of accounting controversies in the red line there significantly underperform the rest of the S&P 500 over the years. And this is from, again, 2006, and it's a monthly rotation model. And they underperform by again, quite a significant amount. So this is an interesting finding, and we have many other controversy indexes. The literature on sentiment analysis of media finds that it's often negative news that has the greatest impact on future price direction. And so when we created this data set, we created about half of all of the indexes are solely focused on negative news in the ESG realm. So we have a number that you can see here, like activist investor activity or insider dealing controversies, or regulatory issues. And many of these controversies do show value, and it's often orthogonal. That is, one type of scandal is not the same as another type of scandal. Some scandals don't cause negative price drift, but some do. And so that's what's quite interesting here. And then some are not consistent. Like I said about the findings by Bank of America that most ESG returns seem to come in the past 5 years, what we see here is the sustainability controversy. So this one was quite a cool finding, because we see that the top 10% of most controversial companies were actually outperforming from 2006 up until 2015. Now, largely these are going to be energy companies, but nonetheless, we see that they were doing very well, but they actually have been, since 2014, their share prices have actually gone negative. So while the S&P 500 has plugged on and has gone positive. So unsustainable companies were, these so-called sin stocks, were doing well until about 2014, and then things changed, largely because this is the energy sector, but in general, these are companies that are considered unsustainable, and they are now being punished by the market. And so you can see that this type of data set, when it's used to drive investments, can have a material impact on a company's ability to obtain financing and to continue its operations even. So this data does make a difference in how companies are operating and clearly in how people are investing in those companies as well. So there is an impact being made here. Here's a few simple cases. This is, again, one-off cases. This is Volkswagen, and you can see the scandal around their emissions. Already before the emissions, the big drop in the share price, their share price was dropping anyway back in 2015. And you can see people were already talking about emissions. This had come out in regulatory documents, but just hadn't really hit the big press. It hadn't hit the mainstream press, really how bad this was. Once it hit the mainstream press, it really got hammered, as you can see the share price here. Now, once people stopped talking about emissions controversies, as it started to drift lower, you can see the share price did start to recover quite a bit. But the company has not been the same since. Now, here's BP. BP is interesting as well because they did have the Deepwater Horizon accident, you can see back in 2010, and the big spike in the industrial accident index that we track. And then that started to drift down as well, and the share price has recovered. Now, BP, of course, is rebranding itself and is pledging to go carbon neutral. So this has made a significant impact on BP and their operations. We also track private companies in this feed, a couple thousand of those. This is Theranose. As you can see here, it was at a high level of anger developing starting in 2015. And there was first the Wall Street Journal story about the company and how they had blood testing issues, and then criminal investigation began, and then the book Bad Blood was published in 2018, and you can see the anger again has risen further. So we do have an anger index that is tracked here as well. And lastly is a simple example of Wirecard. So you can see that Wirecard here had management and shareholder controversies that were quite significant on our indexes. And these actually started back in 2019. And so you can see that these were rising and then started really taking off before the big crash in the share price. But these were quite significant already. People were quite suspicious about Wirecard. I know the Financial Times was releasing articles on it. So it was already in the doghouse, so to speak, on a watch list of companies not doing so well. And then before the big crash in the share price. So here's a poll. I'd like to learn a bit more about your understanding of market sentiment in your investing. So I've talked about workplace sentiment and management sentiment. And I guess the thrust of this question is, do you use media sentiment or other types of sentiment, like put-call ratios, et cetera, in the way that you invest now? Of course, most of you use ESG investing, but do you use anything related to media or media analytics? Some people use qualitative. So this is a poll, so if you could respond to these. Some people use qualitative information, like I mentioned put-call ratios, or a general sense of the market, like headlines. If headlines are very positive or negative, they tend to see that as a contrarian indicator. Others use quantitative sentiment data, like we provide through Refinitiv, the markets like indices. Or maybe it's not relevant to you in your job, or no, not at all. So if you could respond to this, I will forward the slide. I guess I have my own response there. Okay, so we're going forward now. Okay, so quite a diversity of responses. So about 30% already use quantitative sentiment data, about 27% qualitative, and for many of you, it's not relevant. Okay, great. Well, that helps us understand your perspective. So this is, for those of you who have not used quantitative media-based sentiment data, this is a different type of data. It's frequent. It is a big data set. It's frequent and it's very granular. It allows you to look at many dimensions of a company, as you saw, based on the indexes we were giving you results on earlier. So now I'll turn it over to our research quants specialist extraordinaire, Tiago Teodoro. Tiago has a PhD in physical chemistry and a master's in financial engineering and is an all-around extraordinarily accomplished individual. So I will let Tiago pick up the presentation here. So go ahead, Tiago.
Thank you, Richard. Yes, so I hope you can hear me. Yeah, so far we have shown some examples about companies, but what I'm going to show in the following are a few examples of how the media information flow can help with quantifying countries and helping also with finding some hidden gems, something that sometimes you don't see so often with data sets about countries. And let's start with the environmental pillar. So something that I was doing quite frequently with this data when we were finalizing it was to rank countries, because that's something fun to do, and compare that with something else. So for example, I would Google, which are the most sustainable countries in the world? And I would get quite boring answers. And the reason being, all the data sets, they were basically showing the same. You see this party of first world countries. You see the Nordics on top, you see Switzerland, New Zealand. And when I look into the data set, which is something that you are seeing now, so this is a ranking of the top 10 countries in sustainable innovation index. And yeah, I also saw the Nordics there. So you see Norway on top. And on the right side of the figure, you see how this score evolved over time. We also see Japan. But for example, in the third place, you see Costa Rica. And I'm Latin American, but that was quite a surprise. I was biased by all those rankings. I was expecting to see only rich countries. And when I look into the individual news to see what was going on, why this score was high, I saw that, well, Costa Rica, 95 or 98% of their energy is from renewables. It was considered by the United Nations the champion of the Earth in 2019 because of their green policies, a lot of natural reserves, forests around the country. So maybe when you look into these data sets, sometimes they are made by people scoring several measures, you can get a sort of like a biased view of the world. But in our case, since we are looking to these thousands of sources from all around the world, you get some more diversified view of that. And we also see some other surprises in this ranking, like UAE, for example. You wouldn't expect that because of the oil, but the truth is you look into the news and you see that there is a lot of investments in green solutions going on there. And the same for China, for example, which also appears in this ranking and is sometimes controversial. So in the last 3 or 4 years, they invested more than twice what the European Union, for example, invested in green energy. That's the first example. The second one, it's on the social pillar, and that's something that, unfortunately, it's still sort of a hot topic because we are still living through it. That's the corona crisis. So what I'm showing here is the Human Disease Pool Index. So we already had some index related to disease in the previous feeds, and we kept that in this ESG feed. So this is basically a measure of how much buzz there is in the media about pulmonary disease in comparison with the total news. And fortunately, this score is usually close to 0, but we can see that around January, it exploded in China. So China is the red line. And then you may remember that there was that outbreak in South Korea. So that's the green line. You see that index also exploding later. And then finally, Italy, that's the yellow line. And that's when the markets finally react heavily on it. And then finally, you see that reaction also in US. But what I find interesting in this plot is that all this time series, they peak around March to April. And as you are probably quite aware of, in terms of number of cases, number of deaths, the pandemic became a lot harsher later in the year. So there was a second wave, a third wave, depending on the country. So what I'm showing here, the orange line is basically the number of daily new cases in the US, 7 days moving average, and the blue line is just the human disease boom, which you already saw in the previous slide. And that's just to put those things together so we can clearly see that even though in number of cases, in number of deaths, the first wave was a lot smaller than the last waves, the media buzz around it was a lot bigger. So it also felt like that because we were paying a lot more attention apparently around March, or I felt like that at least, than I was doing in July. And of course, it's a bit bold to say that markets react only on that. There are all sorts of things going on, like monetary policy. But the truth is, we see that over and over in different cases. We also saw that in previous pandemics, that the bottom in the market is usually around the moment that the media peak. So when the media finally moves the attention to something else, we finally start to hear something else going on, the usual assassinations or bad things that the media likes to talk about, we see the markets rebounding. And finally, on the governance pillar, there was a G20 meeting a couple of months ago, and I was reading something about corruption, so I made the same ranking or a similar ranking as the one that I showed in the beginning. So this is a ranking of the government corruption index over the last 21 years, so since the formation of the G20. And it's a bit sad for me to see that my home country is leading the pack, but I was sort of expecting that. But having come from Brazil, something that I always experienced as an investor in there is that what the media see in the government is usually something that drives the markets a lot. So there is a corruption scandal, which is something that happens quite frequently. You see the markets moving there are a lot of outflows. But after that, it always felt like the markets rebounded. But the thing is, it's difficult to test this kind of anecdotal evidence. But with this kind of data sets, you actually can. Because, for example, we have this government sentiment index, which I'm plotting here for Brazil. That's the blue line in the left plot. And as expected, the bottoms of this feed, they match the explosions of corruption and scandals. And also what they match is this anecdotal evidence of, for example, in 2009, there was the Economist cover showing Brazil taking off, which was like some sort of perspective on the future of Brazil. And that sort of market, the top of the market and also the top of this index. So to test this hypothesis that what the media says is usually like a contrary indicator, and that was also an article that came on The Economist after that, I did a very simple regression. So the returns of EWZ, which is a famous Brazilian ETF, on a given month, regressed on the level of government sentiment in the previous month. And to account for these more systematic variations due to the emerging markets returns, I also regress on the emerging markets returns of that month. And as I expected before, there is a negative correlation. So the lower is the government sentiment level about Brazil, the higher are the forward returns, even after accounting for the emerging market sentiments. So that's it. Richard, back to you.
Thanks, Thiago.
Not sure.
All right. I was just answering some questions there and couldn't move the question screen away. Thanks for all your great questions, by the way. Really good content. I think some of the big themes that are coming up are statistical significance of the research. And I did want to say that the T-stats are below the images on those slides. So if you're able to get the copy of the slides, we do have the statistical results below the slides, so like on those decile spread studies. Then another question that comes up a lot is greenwashing. And what do we do about greenwashing? Well, certainly greenwashing is aggressive, and there's a lot of companies trying to get their positive efforts in the media. We exclude all press releases and corporate reports from this data set. Even a citation in the news media, like in the New York Times, if they say, well, Shell announced a new sustainability initiative in their latest press release, we will get rid of that. However, if it's a legitimate third-party article about a sustainability effort, then we do include it. So if the greenwashing is considered, I suppose, effective by the objective third-party media, then we do include it. Now, while we have 4,000 news sites in here, I know some of our competitors will claim to have, say, 100,000 sites or 50,000 or whatever. Below the top 4,000, a lot of it is garbage, and it's mostly paid promotions, robo-news. and very dangerous content. So we only include the top 4,000, and even the 4,000, they're all hand-picked. We've had to go through them both algorithmically to exclude robo-news, paid promotions, and also to include little-known ESG sources, environmental watchdogs, monitors, labor publications. So very, very granular but important content sets have been included in here. And we do it as much as possible to exclude greenwashing, but naturally, if a company does do something quite impressive and they're the first to do it, they will be in the media and it will be an objective article, so it will be included here. Another, I guess, question I want to clear up before I go into the summary is, how do we weight sources, like credible sources? Is the New York Times weighted more than the New York Post, for example? And in our case, we weight all sources equally as long as they're credible news sources. Now, you could argue that the New York Post isn't credible, or Fox News isn't credible, depending on your perspective. Others would argue, as would the President of the United States until earlier this week, he would argue that CNN and every major news organization is not credible. So you've got differences in opinion, and the question is really, which ones are influencing behavior? Which ones are going to have a sustainability impact? So we're aggregating everything together as long as it is not republishing robotic content or automatically writing it or getting paid promotions. Now, obviously there's propaganda and there's a lot of nonsense that can get into the media, but we're also looking for a universal generalizable signal. We're looking for a signal in this data set. That's why we go back to 1998 with all the sources aggregated together. Because then if we find a signal where we have much more confidence, sources change over time, they change ownership, they change their political leanings, these things happen. And if you rely on one or two or three sources, you have a very brittle signal that will be lost in a year or two when things change. So we're trying to make sure we have a universal signal. So I will now proceed with the presentation and go into questions again a bit later afterwards. But thank you for all the great questions. So the findings that we've had so far, as we've discussed, were, for example, companies with good management outperform companies with bad management. The top decile versus the bottom decile, about 2.2% annually. The statistical significance is fairly weak in that study, but nonetheless, it's an interesting concept. And we didn't look at longer time horizons, shorter time horizons. There's larger data set rather than the S&P 500. Those are future research projects we do plan to do. And probably there will be something quite interesting in there, as is this result. Workplace sentiment is quite significant as well, especially at the extremes, at the top 5% and the bottom 5%. It still looks good at the deciles, top and bottom. But what we wanted to illustrate here is that sometimes when you go out to the very high and low extremes, you get the really top performers and the really low bad performers. And that, when it's really at the extremes like that, that can also tell you there will be nice price drift going forward. So if you have a small portfolio, you can look at these really high extremes, those companies that score really high in some important factors to you. Now, innovative companies also seem to outperform, but what we wanted to illustrate there is you can use this data to find those top performers. But again, this is a 5 to 6 year phenomenon, and it may not last forever. So just as we saw with sustainability, only those companies that are really considered sustainable outperforming the last 5 to 6 years. Same with innovation. And beware of high controversy companies. We see a lot of different types of negative news have a bad impact on stock prices. And so we showed a few examples of those as well, counting controversies and others. Also, in general, we wanted to point out that media flow is faster than other sources of ESG data. So other cases where you have humans doing the legwork, they are going to get on the ground perspective. But as you know, with ESG data, there's a big dispersion of data. And there was a famous article by James McIntosh in 2018 in the Wall Street Journal that showed that Tesla can be scored 0 on their environmental score by one provider and 90 by another provider, and another third provider was right in the middle. There's an incredible dispersion. The correlations are quite low on these scores. And part of the problem is people have different, they're measuring different things. So they're weighting their scores differently, they're measuring different things. And in some cases, for example, they're measuring the factory outputs from Tesla versus the product output of carbon dioxide, and they're not comparing it to peers. There's a lot of these complications. So with this type of data set, we're looking again for a standardized universal way of weighting. Do people feel good or bad about their workplace? Do they feel good or bad about the management team at the company? These are more universal and standardized ways of looking at this data, and it gives us a nice continuous history, again, back to 1998 to work with. Also, we can find with this data, again, hidden gems and some laggards of the ESG. So this can, in an alerting system or a heat map, we can very quickly see who's underperforming or where are their problems developing. And so you can use this data for a number of different applications beyond just portfolio management. So there's a lot of interesting alerting systems and perception detection that can be done. So lastly, like I said at the very beginning, we do have 3 products with Refinitiv. We have the MarketPsych Analytics, or MarketPsych ESG Analytics, which we talked about today. Underlying that and a precursor to that was our MarketPsych Indices, which has now been renamed the MarketPsych Analytics, which is covers emotions and various sentiments about every major company, 30,000 companies now. Again, also back to 1998. And then we have a predictive model that we built with the StarMine team that launched in January of last year. And we now have a year of forward testing and real-time use under its belt, and it continues to have a sharp ratio of 1 between the top and the bottom decile, covering, in that case, for 5,000 US stocks. And it's now been expanded to global. So we have global coverage with that, covering over 16,000 global companies in a single once a day, 1 to 100 score based on how it's likely to perform going forward in the next month using media analytics only. And it turns out that that score is actually uncorrelated with traditional quant factors. So it's quite an interesting media signal. So we do have 55 academic papers on this data set already, customers in 25 countries. It's been picked up quite widely. And so if you are interested, please do reach out to us. We will be launching free trials of this in a week or 2. And I'll let the product team handle those queries. But do reach out and we will welcome you to test the data and see what you find. So thanks again for your time today. And I will turn it over to Barney if there's any last words.
Oh, before the last words, I mean, this was a very, very engaging audience. So thank you very much for all those questions. And as we have time, if you don't mind, Richard, I will ask a few from you guys. I have tried to move them all to a separate screen so that I can still follow the other one. First question, is there a composite view instead of breaking into granular ESG subcategories?
Yes, that's right. So in our core scores, we do have an overall ESG composite view. We also have an ESG controversies view. So you can get both of those simple daily scores based on company performance. And those actually, on the course data set, they are based on the last 365 days of media. So it gives you more of a slower moving perspective on what the company has been doing and what they are working on now. So yes, we do have a composite view in our core data set.
A lot of questions were revolving around credible news. So what if 2 credible news sources contradict each other? Are they still equally weighted? Why are weighting not calculated using empirical evidence? Thank you.
I'm not sure. So the media is all perception. I mean, I wish there were empirical evidence, but I think that's the difference with this type of data set and Refinitiv's fundamental data set, where human analysts gather the empirical evidence from the company or from the corporate filings. In this case, we're getting what does the media say about the company. And it has its own type of value. It doesn't cover everything. I think there's no single ESG data set that will handle everything, unfortunately. But this one does pick up on what the perceptions of the company are. And what we are saying in this presentation is that those perceptions do appear to drive prices as well. Now, we can't really judge whether those are accurate or not. I'm not sure that, I think we all personally have our opinions and perspectives on what's accurate and not. But when we aggregate them together, what we're saying is there are, if there's 2 contradictory opinions, they will balance each other out, and it'll, the score will be a 0. So if this is credible news, though, then on average, on net, you're going to get a general signal. And again, our goal is to have a universal, generalizable, objectively created signal. Now, the source data, the text, may not be objective, but it does appear that it influences corporate behavior and it influences stock prices. Companies care what the media says about them. The media says they have unhappy employees. then they're probably either going to take action or not. And if they don't take action, we see that their share prices seem to suffer. At least they don't take effective action.
Thank you.
Yeah, I hope that answers the question.
Quick one. Is there a dollar corruption index?
I'm sorry, a dollar corruption index?
Yes. All right. That
There's
was
a corruption.
the only...
We have a government corruption index for every country. So we have 252 countries. So we can track government corruption. We also have currencies data, but I'm not sure what.
Okay. Thank you.
Maybe
I think that...
Okay, go ahead.
Do you consider supply chain dependencies when you analyze sustainable innovation by countries?
Yes, we do. So we do have a supply chain. We do track supply chain issues and sustainability. And that is under one of our, so we do have 252 indexes. One of them is, has a subset of it is supply chain sustainability. I forget the name of that index, but yeah, we do.
Thank you, Richard. Another one, is there any difference in ESG portfolio returns when you use only MarketPsych data and standard ESG scores? Did you look into that?
Oh, no, we haven't tested that yet. So this is a new data set. So these studies that we saw here that Tiago produced are S&P 500 only. We haven't compared it with other data sets yet. I would imagine, based on what I've seen by Bank of America and these other quant studies that I've seen, these results do seem quite good and different than what I'm seeing that others have. But again, we haven't looked at other data sets yet.
Yeah, and maybe this is just a comment from my end, if I understand the question right, that this is the revolving one, that, you know, this can be sort of not interchangeable, but compared to each other, if the methodology of the corporate-based data and the sentiment-based data are aligned or very similar. And this is maybe one of the powers of this product of yours. Just another one. How does information risk fit into ESG? Would that be something that you could?
Yeah. Well, I guess what is information risk exactly in this context? I don't know.
Not using information to filter out other risk, but the risk of information itself, i.e. disinformation, privacy violations, infinite synthetic media, mangled content.
Yeah, there is that risk. I mean, that's one of the reasons we're only looking at sites that are legitimate. That said, we also have social media in here, and we have tens of millions of social media authors who get in. We have multiple filters around that, so we're looking for promoters and botnets and people who are working together in teams to promote certain perspectives, and so we eliminate those as well. We've been doing this for many years. But it was a challenge, though. For example, in the hash crash, in I believe it was 2012. When the Free Syrian Army hacked into the AP, the Associated Press account, and said that Obama had been injured by a bomb at the White House. So that was the Associated Press Twitter account that said that. In that case, we won't be able to detect it, but we were able to detect a minute or two later when people said it was a hoax. And then we could pick that up and relate it to that original tweet. So we can do that type of detection. It's quite challenging, of course, because misinformation does influence people. And we also have a misinformation index by country that we track, and we try to keep track of this. But certainly, we also, with companies, have an advertisement deceptive index. So we're looking for false advertising and misrepresentations. So we have those for countries as well, or companies as well. And I believe that one actually did have some interesting quantitative results. Another one that might be relating to this, we know that China's state-sponsored media is selectively facts-based. How do you include? Right, so, well, related to companies, that's a good question. Related to companies, we find that the business news is usually a bit more objective, and if it becomes negative about a given company, then yes, there's going to be probably a persecution via the media. So, for example, if the government starts leaking negative articles about Rosneft or some company in China or Russia, it might be that it's preceding a political attack on that company. So this data can alert you to that risk as well. That said, is it fact-based? No. Does it take down the company? Yes. So you want to be aware of it. Again, it would be nice if we all believe we have an objective handle on the truth based on our own judgment and opinions, but the challenge, and probably the very frustrating challenge, is maybe we don't always, and we definitely don't have control of the media at times. So that's a bigger question. But no, we don't. Misinformation does affect behavior. It does affect share prices. Greenwashing is a type of misinformation, of course, as well. And we, in this case, eliminate press releases. We eliminate sources that only promote one perspective. That said, most sources try to promote multiple perspectives to appear more objective, even when they are doing misinformation. So we have a number of machine learning-based filters on this, and also human static filters, but I'm sure that content gets in to some extent.
Thank you. Just a question around timing. When were the models that are used to create the graphs from 2006 to 2021 created? Those
models were created 2 weeks ago, based on this data set. Yeah. Like I said, though, the techniques we used with creating those models have been robust. They've proven robustness over time, and the evidence for that is in our StarMine models that we've released that have maintained exactly the same spread that we had back in January when we released them, and just as they did in the out-of-sample sets. So while this may look like we just cherry-picked it and fit a model and then we're showing you, and I think Tiago would agree that these are not final models for trading. More work has to be done. That said, when we do find relationships in this data, that data does seem to bear itself out in the real world if you do good, rigorous research on it. And we're at the beginning of the research, so we're not telling you to just use these models, but we are telling you that there does appear to be value in this data right now.
As we are already on this topic, there is, and of course, caveated with everything, there is a question around that. What is the significant time frame for which these quantitative findings can be used for financial decisions in trading? So all understood what you just said, but anything on time frame?
Well, yes. So we've seen in preliminary research, we saw value from daily to yearly holding periods. And in this research, we only showed you monthly, but we have in ESG indexes seen value from at least daily. We haven't gone less than daily to minutely, but we definitely see value in daily to yearly holding periods. We've also looked out to 3 years, and we've seen some value there as well. So it's quite diverse. You can find value at many different time horizons.
Thank you very much, Richard. We have a couple of more questions, but we have unfortunately reached our time. I just want to tell you all that we will get back to you in an email for any questions that we did not respond to. And there were a lot of questions around the presentations. We are going to also put it as a resource and include it into the post-webinar follow-up. So. Personally, this was one of the quickest flying hour on a webinar for me. Thank you for all the great insights and the great presentation, and thank you for the audience for this really amazing engagement. It was really a pleasure hosting this event, and hoping to meet you soon on another event of ours and talking to you on other occasions. Thank you very much. And with that, we conclude the webinar.
Thanks, everyone.
Thank you.